try to understand the EV to EBITDA multiple. So the EV to EBITDA multiple, it takes into account the enterprise value in the numerator and the earnings before interest, tax, depreciation and the amortization in denominator. So basically enterprise value is nothing but the total value of the firm in terms of the market value of the equity plus the market value of the debt plus minority interest. Now these are those people who tend to hold less than 5% stake in a company, and then we subtract cash. The reason for subtracting cash is cash being non-income generating asset. Cash is non-core for the business. And in the denominator we have EBITDA as an earning before interest, tax, depreciation and the amortization. So EBITDA is basically excluding the impact of the depreciation and the amortization. Why? Because basically this metric is being used for cyclical heavy industrial businesses like a cement, a telecom, a real estate, infrastructure. So the quantum of investments into the tangible assets or fixed assets might vary, and hence the amount of depreciation being charged upon those fixed assets for different companies might be different as well. So hence, to value the company based upon a similar parallels or to establish a common ground, we tend to use this EV to EBITDA multiple. Again, this multiple can also be used for the asset light businesses like a tech company, an AI company, a platform based businesses, because these companies will be having amortization and not depreciation. Hence, this multiple can be used in both the scenarios. The third most important thing is we need to understand the depreciation factor. Hence, the ratio of the EBITDA to EBIT is nothing but your depreciation factor, because the difference between EBITDA and EBIT is nothing but depreciation. So if this depreciation factor is a higher number, the spread between the return on invested capital and the cost of capital will be a smaller number. The company will be able to sustain the competitive advantage period for a smaller number of times or for a smaller time period if the depreciation factor is a higher number. But if the depreciation factor is a lower number, in that case the company can have a competitive advantage period, that is the spread between the ROIC and the cost of capital being much more higher. So that is basically EV to EBITDA multiple.